Okay, just to really start this out the right way, I want to address the people who watch the replay at 2x speed. That's fine that you do that, but keep in mind the reason sometimes that there's a slowdown in the talking and everything is because I do read and respond to the people in chat, and that might make for what seem like unnatural pauses on a rewatch. So it's fine that you do that, but you don't need to comment that you were using 2x speed. It doesn't add anything to the conversation. Cue everybody then commenting that just to troll me. So we're getting ready to start up a new week, and we're thinking, okay, is it going to be Black Monday 2.0? Friday was certainly a deeply, deeply red day in our portfolio, minus about $2,000. However, our number one position, MPW, had a pretty good run this last week and was not the reason that the portfolio was down. This was more of a broader market type situation. And this week we're looking at some potential developments again with the Steward bankruptcy. We're looking at possibly a sale in Prospect PHP Holdings. Okay, good one. Good one, Stabulo. Good one. We're looking at a possible sale of Prospect. And, of course, we should be getting our dividend here shortly. So, and as you know, dividends are free money. And I always enjoy collecting the free money from the sky. That's why, of course, I'm not as smart as the people who invest in Yieldmax. They're obviously a lot smarter than I am because MPW only pays about a 7 or 7.5% yield on today's share price, whereas Yieldmax pays like 80 or 90% on all of their funds. So clearly, I don't understand how to make money. I need to suspend my disbelief a little bit more. That's like going to a gay club and asking if there's any women there. You know what I mean? So I think drip day, whenever that comes, I forget the exact. We have X dividend coming up. I forget what the actual payment date is, but that'll be drip day. That'll be probably pretty good. Not as good as it used to be because the dividend's a little lower. I do wonder what the new data will say about short interest because it was at 40% last time we looked. And if we continue to have more buying pressure and the stock slowly goes up, will there be a stampede to the exit for shorts where they give us a sort of miniature AMC style squeeze? I don't know. I'd love to see that happen. Could not happen to anybody that is more deserving, in my opinion. Oh, well, except for maybe when certain Yieldmax bulls get absolutely wrecked and margin called and get their accounts at Charles Schwab shut down. That might be a little bit more deserved. But I think that the people who short MPW, especially the big names. Now, granted, they may not actually hold actual short positions. They may just be paid bashers, as it were. Your Rob Hedgeye, your Pairing Viceroy. But we have some interesting articles. I mean, suddenly, now that the stock is up, of course, material upside from current levels. Possible bullish catalyst. You weren't seeing these kind of articles when it was $3 a share, only now that it's closer to $5. Yeah. It's funny because when it was $3 a share, everybody was saying how you got to get out now. It's terrible. It's terrible. Zach's just upgraded it to a strong buy now that it's higher. But where were you when it was $3 a share? If it's a strong buy at $4.50, surely it was a strong buy at $3. But I think the MPW retail investing community we're the only people that think it was a strong buy at $3, I guess. Bunch of fair weather friends everybody else has been. Yeah. Granted, everybody likes to pull up the 5-year chart. Mm-hmm. The 5-year chart, from what I understand, matters the most if you bought it 5 years ago. Not a single time did I ever spend $19 or $20 or $24 per share on this. And my thinking is, if you bought in for $24 a share, you just outright overpaid. You just outright overpaid because the market was inflated and it was like, oh, it's a dividend, it's safe, it's good, it's free money. Obviously not the case. Now, granted, they were paying over $1 a year in dividends at that level, so it was still actually a better yield than like a realty income or whatever. But that just, I think, goes to show how overvalued something like realty income was. It's not like any REIT is actually 100% immune to the factors that have led to MPW's share price decline. Watch the dollar stores and the Walgreenses start to struggle really bad, like they have been recently, and start to have trouble keeping stores open that they rent from realty income. And you could see some problems start to happen for realty income. They're not invincible. Same thing with Vici. See a recession where tourism to Vegas stops happening, where people don't fly out and do vacations in Vegas as often. See the hotels and casinos struggle to fill seats and fill rooms for a prolonged period. 6 months, a year, something like that. And you might see some problems in Vici as well, potentially. None of these REITs is invincible if something happens in the tenants that they cater to. And while Realty Income doesn't have any individual tenants the size of Steward, they do have groups of tenants that are in similar types of businesses to each other, where if that entire line of business starts to struggle in the U.S., or abroad, because they are international, they could do poorly. I think that the lower end retail, and by that I mean things like your Dollar Tree, Dollar General, Walgreens, whatever, 7-Eleven, that kind of thing. If that type of business starts doing badly, which they all now have to exist in the same universe as Amazon, for example. Like, who actually wants or needs those stores anymore? And the neighborhoods they go into, generally speaking, are the ones that have the highest rates of things like shoplifting, etc., which, with the margins being as low as they are, they can't actually stay profitable if they have too much shrink. So it's pretty bad. It's pretty bad. Any kind of bad economic conditions, plus the existence of just better, more convenient options for the people who can afford them, mean that they can only ever really appeal to the lowest common denominator in the market. And sometimes when things are tough, the lowest common denominator is the most likely to resort to I'm going to just take this and walk out and take my chances and not pay. So we're seeing them sort of reap the rewards of that strategy. But Realty Income will suffer pretty badly if Walgreens continues its downward spiral, and the dollar type stores also kind of continue to struggle a little bit. Granted, it may not be to the extent price-wise that Realty Income or that MPW has struggled, but Realty Income can definitely have challenges. When you start thinking of a company as invincible, that's kind of when you're at the most vulnerable in a lot of cases. You see people, including my Cashflow Kings co-host Ryan, I wouldn't sell Apple here. I wouldn't sell Apple here. That's what he says. And granted, I don't think he should just because other people say he should, but in his position, I 100% would let go of Apple here. I mean, it's up how much? 26% over the last year. Tripled over the last 5 years. Have the fundamentals tripled in the last 5 years? Have they? I don't think they have. I could be wrong, but no, I don't think they're tripled over the last 5 years. Like, can you imagine? Like, does this look like the revenue then 5 years of quarterly revenue of a company that should have tripled in price over the last 5 years? You might be saying, but fiscal philosophy, you're not very smart at all. They've probably increased free cash flow by they haven't done that either. But surely their free cash flow per share has tripled. Nope. I mean, it's gone up a little bit because of their buybacks, but this is not. Is this worth 3 times this? No, it is not. So, but surely it just must be at a cheap multiple, right? So, with the Magnificent Seven type stocks, of which Apple is, of course, one of the leaders. So that would be like your Apples, your Microsofts, NVIDIA, Amazon, Google, Tesla. Tesla, the odd man out there. I've been assessing their business growth and their priciness, like how pricey they are relative to each other based on the price to operating cash flow. Apple has just been consistently getting more and more expensive over time. They aren't actually that much better. They've grown a little bit, perhaps, in the last few years, but they're really just getting progressively more and more expensive. People are just willing to pay a higher and higher multiple. Something's got to give at some point on this, right? And you compare that to an Amazon, which I'm expecting more growth than you're getting from Apple, right? Now, granted, it's not like a parabolic line, but it is steady growth. It's still in the double digits here on a quarter compared to prior year quarter basis, right? And you have now the free cash flow, of course, is not due to CapEx, right? But when you look at how their valuation has progressed, Amazon has actually gotten cheaper over time. Amazon has gotten cheaper while Apple has gotten more expensive, while Amazon's growth is better. And people wonder why I would rather buy Amazon over Apple. So Amazon right now is at the cheapest multiple to operating cash flow that they have been at in the last 5 years. Right now. Right now is, by the numbers, possibly the best time ever, at least within the last 5 years, to buy it. Probably ever. Maybe we could look at data further back sometime to really see if that's the case. But yeah, right now, best time to buy Amazon, maybe ever. That's pretty wild. Now, it could always go lower. Granted, yeah, it could collapse to 140 or 110 or something. I would probably be looking to like sell a kidney or something at that point to buy more Amazon if it had a 2022 style price collapse, because right now is technically the cheapest it has been according to my criteria. So, and I mean, I think that the overall market does have some room to fall, by the way, but I think if the market has a bigger correction than what it's had recently, what's going to lead the way is going to be Tesla, Apple, and I mean, if chips keep suffering, maybe NVIDIA. I think that's where the S&P is going to lose a lot of their market cap. React to new CFK upload. Trust me. Like, do you mean like go onto YouTube and you got to tell me what you mean, buddy.
Carrie Lake wants control.
Only a minute. Okay, like that isn't answering the question, but okay. I'm going to see what you're talking about. Is it a video? Is it a short? Oh, this. Yeah. So yeah, I will do that. So this actually,
you get your money back or you buy this, and
this relates to this 100% relates to the last whatchamacallit, yesterday's live stream, right? The Yieldmax stuff. This 100% relates to that. So, but I need to control my desktop audio a little bit because he goes on one on this. He goes off. So,
and that the first thing you guys talk about is like NAV erosion, cap erosion. Who give a flying fuck about that shit?
mm-hmm.
It's ridiculous. At some point, you gotta like grow up. Otherwise, get the F out of here. Why would you come hang out and come in and just even just to ask question like that? That's like going to a gay club and ask, hey, if there's any girls there. Get the F out of here, man. Allow us.
So, quote of the century. Going to Khmer's channel and Discord is like going to a gay club. Quote of the year.
Let us, if you don't want to make money, that's fine. Then get out of here. Let us make money. We know how to make money, and we're gonna get rich. That's what pissed me off the whole time. Every one of these investment community out here, all these YouTubers, they're all freaking idiots.
We're not very smart at all, as he likes to say.
They all think they know what they're doing.
So a lot of people on YouTube actually do know what they're doing, unlike Khmer, who he doesn't have a clue. The thing is, he is so clueless that he doesn't even know how clueless he actually is.
With zero. Just think about zero. I didn't start with $100,000, $200,000, zero. And now I'm making $10,000 going to $12,000, and they tell me that I still fail.
So yeah, he's making an error there. He started with zero. And this could be the first guy to ever brag about starting with zero and turning it into negative, because he's going to end up with negative equity and owing Schwab money by the time he's done. Pretty sure of that. And he's not making $12,000 a month. He's receiving $12,000 a month. Well, probably less than that, because he keeps lying on that. Schwab actually, when he was claiming he was getting 10,000, Schwab was showing it that he was getting 8606, because the payouts keep shrinking as the NAV erodes. He just is too dense to understand that. And so the reason we know how to use margin, because we know how to use margin. Now, he's not actually profiting $12,000 a month, though. His total returns are deeply, deeply negative, because the net asset value is actually eroding faster than the payouts are coming in from these funds. And he doesn't realize that at the end, he's going to have less than when he started if this continues. But because these payouts keep coming in, he thinks that he has this consistent, reliable income stream that he can retire early on. And it is just not the case. And he's deeply in debt, which he is paying like 13 or 14% interest on to Schwab. I'll look up the Schwab margin rates if anybody cares about that, while also having the NAV erode, and while also paying 1% to the fund managers at Yieldmax for the privilege of bankrupting him, basically.
Well, screw all of you guys.
Screw all of us. For telling the truth, screw us.
That's
Well,
the
I
most.
didn't say you're going to fail. I'm just questioning, like, to understand the logic, if there is one, or if it's more
No,
like
because the reason you're asking this question, because you fail to suspend the belief. I come in the community.
The malapropisms from Khmer are freaking hilarious. You fail to suspend the belief. What he means is you fail to suspend the disbelief, I think, which suspension of disbelief is when you set aside your realism or your skepticism or whatever to allow yourself to be able to become immersed in a work of fiction. And he is saying that you need to do that in order to buy his. He's basically, without realizing it, admitting that it's all a fantasy and that none of it's real and that it's all going to fail. He just hasn't yet consciously realized it yet. He's sort of tacitly admitting it. So, anyways, that was fun. Oh yeah, that was Columbo. That was Columbo from our Discord, Investor Columbo. Yeah. So, and by the way, like, he's like, Columbo is actually like one of the most polite people ever, and is probably just legitimately trying to give them actually the benefit of the doubt and ask them legitimate questions he has about the thesis behind the Yieldmax investment. There is none, especially not on that server. Like, there's people like I think we had Coach on the Cash Flow Kings, and he was talking about having like maybe at any given time like 10% in a fund like this, but as like as a part of an overall comprehensive strategy, not as like an all-in, this is going to help me retire early type thing. And there's and I've even talked about the fact that there could be potential use cases, and I don't know that I would ever personally use them, but there could be possible use cases for a Yieldmax fund. But yeah, again, no sane person would think, oh, I can just put all of my fund, all my money, all my investable money into these funds that claim, or that on the sticker on the front end it says 80% yield or whatever, and clearly and think that that's going to actually sustain over time, and you're actually going to consistently have $10K a month in income on a $100K account value. It just is not feasible. But back to the market correction that may come. I think Apple, NVIDIA, and Tesla will probably be leading the way, which sucks if you're like Khmer, because a big portion of his money is tied up in TSLA, which is tied to Tesla. So that'll be very painful for him. Also, I think with any correction, major correction, we'll see probably a continued outflow from cryptocurrencies because their valuation isn't based on a whole lot. And if people are losing confidence in the markets as a whole, or there's a recession, people need money just to live, they'll pull money out of there first. Store value, hedge against inflation, blah, blah, blah. None of that's true either. Yeah, oh yeah, I'm sure Colombo got banned. It's too bad. It's too bad. Thinking is not encouraged in Khmer's Yieldmax focused community. Whereas, and I think you can vouch for this, I actually welcome people to say things that are not pumping the stocks that I've invested in. I don't want an echo chamber full of pumpers, because then I will never learn anything and I will never improve. And if I'm making mistakes, I will keep making the same ones if the thoughts are never challenged that lead me to make those mistakes. That's true. That's true. I did tell you that. I said, no, you just need to believe more. You just need to believe more in Walgreens, and that'll turn the business around. But you just need to suspend your belief. Suspend your belief. Look, going into Walgreens is like going into a gay club. I've heard that if you go into the restrooms there, you'll be crapping very close to another guy and become very close. And these only about 3 people out there will get that joke, but it was worth it just for those 3 people. So yeah, I do believe though there could be a pretty sizable correction in the near future. I mean, September, it's typically a tough, turbulent month, but if the overall market's down, it's going to be led by Apple, NVIDIA, and Tesla. Now, I do think some names like Amazon, Google, Meta, which are potentially still reasonable buys today, could drop in sympathy with that overall correction, but they would actually still be opportunities versus just corrections, in my personal view. And of course, MPW is not really trading in correlation with the overall market right now. It's trading based on its own catalysts. So I'm pretty happy that it's my top position, and a lot of the various X factors are playing out right now. So it might sort of prop me up while a lot of my other investments maybe take some punishment during a downswing. Google 120 is your voodoo level. Were you doing technical analysis on that, Stabulo? Is that where, oh, Jesus, 4%? I didn't realize Google fell 4% on Friday. Yeah, I mean, here's the thing. If Google got to 120, I would probably press the gas and I would do something drastic to get in if Google hit 120 for sure. It's borderline right now. With it being at 150, it's borderline as good, almost as good of a deal, I think, as Amazon. It's getting pretty close. Yeah. Amazon is marginally cheaper based on operating cash flow, but Google's starting to look hella attractive. But you can see when we look at specifically the operating cash flow, Amazon and Google are in the mid to upper teens in terms of their multiples. Apple is like 30. And by the way, it's just been multiple expansion, more so than business growth, causing their market cap to go up, which is why I think that if there is a major market correction, a lot of it's going to come from Apple probably. Which, yeah, I know the famous, like, predicting the downfall of Apple could be viewed a little dubiously, but this is of course just me saying my honest thoughts out loud. Any of them are welcome to be wrong at any point. You think you're with me on that one? If Google hits 120, it's basically you have to put any possible dollar you can possibly find into it, because that would be my view, unless Amazon also fell that much, and then in which case probably still sticking with Amazon. Although I think, I mean, and this has just been my speculation, that if people view any Magnificent Seven downfall as like an AI related thing, I think Amazon takes maybe less of a hit because they're still viewed so much as e-commerce and AWS, and which is just regular cloud stuff. I don't think people are really thinking that Amazon is the big AI player. It may, again, fall somewhat in sympathy, but I think it hurts them less. If that's what people view as like the AI bubble bursting, I think it hurts Amazon less. Apple, that's an interesting take. We tire on dividends. Apple too woke. I don't know if that's the case. But I do know that Amazon is, we'll just say, able to pull some very, very powerful profitability levers. I think ad revenue is another big thing that could be a growth area. Like I see ads on my Prime Video stuff now. If it wasn't something that I bought or rented specifically, like if it's just the stuff that's free on Prime. But what they do, and this is something I really love, they basically don't do it in a way that interrupts the experience. Like you sit down to watch a movie on Amazon Prime Video, right? You're expecting maybe an hour and a half, 2 hours of movie time. You click watch, and it front loads the ads, so you get like 2 or 3 minutes of ads on the front end, which it's a lot like when you go to the movie theater and you sit through a few trailers or previews or whatever. The movie theaters, they advertise to you, even though you paid for a ticket. And on Prime Video, even though you pay for Prime Video, they give you what is essentially an equivalent thing for your at-home experience. But then you're not getting hit with ads periodically throughout the middle. You're just taking your 2 or 3 minutes up front and, sitting through a handful of ads. And it gives you a similar kind of feel. It gives you that movie theater feel. Even VHS tapes, when I was growing up, if you rewound them fully and then put them in the VCR and watched them, they would have like movie theater style like advertisements on the front end for other movies that were being released on VHS soon. Do you mean Amazon? If you're talking about Amazon, I've been buying it anything under 200, I think, for Amazon is my sense of it. Oh, Warner Bros. Discovery. So I actually really, really like Warner Bros. Discovery. I actually was in it at around $8 and sold it like break even. I mainly because I was wanting to funnel money into Disney. I also got rid of Comcast around that time. But yeah, Warner Bros. Discovery is very attractive. So I've been talking about free cash flow and operating cash flow and stuff. Okay. $2.2 times operating cash flow. Yeah. That is what we call cheap. I mean, what's reasonable for something like Warner Bros. Discovery? Is it 8 times operating cash flow, something like that? Which their free cash flow and operating cash flow seem pretty closely correlated. They don't have positive net income, which is, I wonder why the big discrepancy, but I'm sure there's an explanation in the accounting somewhere. But yeah, Warner Bros. Discovery brings in a good amount of cash and is selling for a very small multiple of that cash. Well, the reason for that is, of course, the balance sheet. But they have been improving the balance sheet. I want to show you what they've done since. So the big spike in Warner Brothers Discovery debt here is when the spin-off merger happened. Okay? When AT&T spun it off and merged it with Discovery, they sent about $40 billion of debt with it. So you went from like low teens into like 50 billion territory worth of debt. They have, since the merger, almost every single quarter, they have chipped away at their long-term debt. So they're clearly addressing the thing that people list as like the big drawback. Anytime somebody doesn't buy, or they talk negatively about Warner Brothers Discovery or why they wouldn't buy it, why they're not considering it, it always comes back to the debt. And maybe a little bit of the decline of linear television, cable, that kind of thing. But mostly debt is what I hear. They're addressing that. I don't know how well they're doing profitability-wise on their Max app, that includes like all the HBO stuff and everything else. But one must think that now that Disney has figured out how to be profitable on streaming, that surely Warner Bros. Discovery will, Paramount will, Comcast will with the Peacock streaming service. They'll all probably get there eventually, all the major ones. Also, there is the possibility that they start to look attractive at these low multiples of cash flow as an acquisition for one of the bigger boys. Now, I don't think Disney is a reasonable possibility. I think Lena Khan would have something to say about it if Disney wanted to acquire yet another big media company. But, I mean, at these prices, like, who's to say Amazon couldn't come in and offer like $30 billion or something? I mean, Warner Bros. Could be pretty close to the too cheap to ignore price already. It's gone nothing but down. So like, it's got negative momentum. Yeah, but it's not failing. I wonder if there was just like some big write-off or something, and that's why the net income is negative. But surely, if they're Okay, yeah. Asset write down and restructuring, 9.7 billion. So I think that's probably why that is. But I mean, look at their operating cash flow. That's pretty ridiculously good. Now it's not quarterly, it's not super consistent, but still, like on the whole, the last several quarters, it's been pretty good. Like these are all relatively decent numbers for the market cap they're at right now. There's some variability, but on the whole, they've produced a lot of cash for how cheap they are. They're so cheap. But, you know, it is a thing with the leverage, right? Yeah. Yeah, the linear TV stuff is a problem for sure. Yeah, I was 100% against the idea of buying T at the time just to get a piece of the merged company. My view was I wanted to see how they did for a few quarters before considering getting in, which in that case, my timing actually turned out to be good for once. So, I've sat on the side. I did briefly get in at around $8, but also out around $8. It was a break-even trade. But that was just a consolidation thing. It wasn't because I thought it was a bad deal at $8. But yeah, we are getting to the point where I think maybe it's worth another shot here. Because at some point it can't just stay at 2 times cash flow forever, right? Like that's not realistic, is it? Like really, I'm sorry, 2.6 times free cash flow. Like the share price falling has all been multiple compression for the most part, not actual deterioration of fundamentals. This is the opposite. This is the inverse of what's happening with Apple. With Apple, the price increase has all been multiple expansion, basically, rather than real growth in the business. And with Warner Bros. Discovery, most of the price decline has just been multiple compression instead of deterioration of the fundamentals of the business. That's really funny. But I would much rather buy a company whose fundamentals aren't deteriorating, but the price is, than one that the fundamentals aren't really increasing all that much, but the multiples seem to keep just blowing up, because that's just bubble-ish behavior on the part of Apple, versus this is just negative sentiment. It seems like the numbers don't seem to support the price collapse that we've seen in Warner Bros. Discovery at all. Yeah, there probably are examples where the price stays like this longer than you'd think. I mean, heck, MPW has stayed cheaper longer than I've thought. I definitely expected more movement in the positive direction by this point. But hey, I don't have paper hands, so I think I'll be okay. But I do definitely want to. I think I want to keep WBD in the old bullpen, because this could be juicy. And Stabulo, were you not saying that when you looked at how the debt was structured, that it's more of a ladder and there's not like an actual debt wall where a huge percentage of it comes due in a very short period of time? Which means that this debt is probably unlikely to, no debt wall. Okay. So that's another positive Warner Bros. Discovery has. And they've been buying back future debt at a discount, I assume. So debt payoff is something they can do with the cash flow. So the debt payoff does not get deducted from the cash flow, to my understanding of how the accounting works, because all free cash flow measures is cash flow from operations, which paying off debt is not an operational expense, minus CapEx, which paying off debt is not CapEx. So no, the cash flow number is not affected by what they use to pay off excess debt. They can pay off excess debt with what they receive in cash flow. What it does, though, is it lowers it basically lowers the amount of cash they have in the balance sheet by however much they use to pay off debt. But actually, it improves potentially their book value if they pay off future debt for less than like the coupon. So like if they had, say, $1,000 bond due in 2030 and they pay it off they buy it back for $600, there should be like a $400 improvement in the balance sheet, I would think. By the way, I'm not an accountant. I just try to understand the basics of accounting for looking at these companies. Any CPAs out there, feel free to correct me if I'm wrong about anything. But yeah. Considering how bad the situation was, I really like how management has dealt with it, and faith in the management is a big deal. Yeah. I mean, the way I see it, they've basically, let's see. Okay. So in 2022, they basically got handed the ish sandwich of $51.3 billion in debt from the spinoff. And they've already chopped that down to 37.3. So that's like something like 27% of that debt has been paid off since 2022. And the only reason that's possible, and you will notice that the free cash flow that they produced does not add up to what is it, like $13.5 billion or so that they paid off in debt. Well, where did they come up with the money? Well, like Stabula said, they've been buying back future debt for cheaper. That's how they've managed to make that happen and deleverage their balance sheet, basically. So I'm definitely I'm pleased also that they've managed to do that. And I think it makes them look more attractive to lenders if they were to need to refinance any of the near-term maturities. Like maybe they temporarily have like a bit of a cash crunch and they need to refinance some debt. I think it makes them look like a safer bet if they have a little bit less leverage out there on their balance sheet. I think people might be reluctant to give them a good rate if they're just absolutely leveraged to the tits. So I submit this question to chat. Do you think we'll have a Black Monday 2.0? Even if we do, I've made British American Tobacco the second largest holding I have recently. And, I mean, oh man, totally wish I would have really increased when it was below 30, but I've done pretty well on this so far. I like it better than Altria Group for reasons I've explained previously. And BTI it's very defensive. And it's very low volatility. So when the market is giving me aches and pains, I'll at least have a chunk of something that is possibly up when the overall market is down, and also not swinging wildly day to day. It's a keep your sanity type stock, and it's almost criminally cheap. Not Warner Bros. Discovery cheap, but 6.5 times free cash flow cheap, where arguably their nearest peers, Altria Group and Philip Morris International, trade for much higher multiples. Well, Altria Group, it's about 10.5 times free cash flow. Philip Morris International, I think it's like 18 times or something, but they're getting like a bump from the enthusiasm around ZINs. But I do think it shows BTI is probably a bit undervalued. And their cash flow is going to be a lot more consistent than something like WBD. So the market will probably, in normal circumstances, give them a bit of a higher valuation than WBD. But BTI is like, I don't have set percentages of cash or anything like that. I wish I actually had more in cash right now, but it is what it is. It's true. I mean, ideally, I'd like to always have like 6 figures in cash if I had the option, but I don't at the moment. So, but there's always ways to get more buying power. So I think all of the tobacco companies have some type of a nicotine pouch now. But I can't remember what I know with Altria, theirs I think is called ON, O-N, exclamation point. I don't know what BTI's got in that category. I've sort of lost sight of all the different names of the different products in the different categories because I'm not really a user of the products, but I understand why they do so well. If that makes sense. So we've got BTI as the number 2 position in my portfolio. We got MPW as number 1. Neither one is really trading in a way that correlates with the way the overall market is right now. So I think I'm positioned well to be pretty defensive. But I do have a lot in Amazon, and I have a lot in Grab as well, and a lot in High Tide. Grab, I don't know. It's been these weird little swings within a range lately. High Tide earnings are coming up, by the way. This is Canadian cannabis. Yeah. Yeah, it's big. So this is another one. It's like 6 times operating cash flow, 7 times free cash flow. Most cannabis companies lose and burn cash. Oh, you know, what's really funny about that? I actually used to live in a MAA owned apartment building in Scottsdale, Arizona. But I mean, it was nice. It was pretty well managed. I'd say they do a good job compared to where I moved after. They were more expensive, of course, but you do get what you pay for, right? And of course, everybody's favorite, very crappy chip maker. I'm half joking, of course, because I own a lot of it, but it's Intel. So Intel, I mean, a lot of the price collapse, the recent price collapse has been multiple compression. The recent price increase was multiple expansion. I mean, granted, yes, the fundamentals have also at the same time deteriorated some. It's been tough. But a lot of what is making it look especially bad, of course, is this. This is making it look pretty bad. That is capital expenditures. At some point, these should slow way down, but a lot of their projects are behind schedule and over budget, which is not good. The only positive thing is like price to operating cash flow still, it looks cheap at 7 times. I mean, compare that to any other chip maker, right? But then also they're below book value. They're at 70% of book value. The market almost thinks Intel's a zero here. Like, they think it's going to get liquidated, or they think it's going to get bought out or something. Like, that's the only explanation I can think of. I don't feel that there's a lot of risk at this level, because like what would happen? Like, would nobody buy their foundries or whatever if the worst were to happen? And then again, they'd be paying liquidation prices, so maybe it would be pretty bad. I don't know. Yeah, I don't think it's a WBA situation for sure. I do think one of the problems with Intel is there are so many moving pieces. It is such a complex business with so many different segments and everything. It is difficult to assess as a layman without being like an actual expert. There's challenges with assessing, especially like I'm not like a real big technophile type person. Yeah. I think Yeah, Intel's tough. Intel's tough. There is also like a cyclical element to the client computing and stuff like that. It's tough to know which way it's going to go, for sure. I mean, I'm not happy about the bag holding just because I could have gotten 50 a share for it not too long ago. But I see your point, and yeah, I'm not panicked at this level because it's like, hey, what's Intel going to do? Go down to like 50% of book value? That would be almost silly. They are asset rich, though they're not highly liquid assets. I guess with MPW, I'm getting a lesson in how assets that aren't highly liquid can be a little weird, but yeah. What was somebody else? Celsius. Somebody mentioned Celsius. Looking good at current prices, huh? Yeah. Oh, damn. 31. I didn't realize it had fallen this much. But here's the deal. All right, just to give you an idea, once again, Celsius, 27.5 times operating cash flow, 31 PE. On both of those metrics, Celsius is more expensive than Google right now, guys. A pretend healthy sugar-free energy drink company selling for more than Google. Wow. Oh, you know what? It's also more expensive than in terms of operating cash flow. Amazon. I think I'd rather have my money in Amazon right now. Oh, you know what else is funny? It's similarly priced to Apple. Similarly priced to Apple. Interesting, huh? I wonder if Celsius has a moat. They got a moat, guys? Is it like Crocs with its super wide moat? So yeah, I don't know. But maybe the growth justifies it. I mean, it's pretty good. Oh, it's pretty good, but I can see why people got spooked. It did the deceleration the last couple quarters. that'd be alarming to me. But they've had deceleration in the past. They have had acceleration into deceleration in the past. But if you notice, after this like part where like the peak of their growth went higher and then lower, like the next one went lower, the high was lower, and so on. And now, maybe the market thinks this is the real deceleration. What do you guys think? Imagine if the Celsius had AI, though. Celsius has been taking market share from Monster. Okay. So, all right. $400 million in revenue quarterly. And I think we could safely say going forward, it'll be minimally in the 350-400 million range, possibly higher, inching higher. Okay. All right, and let's see what that compare. Okay, they've been taking market share from Monster, which is still growing but very slowly, and closing in on $2 billion in quarterly revenue. Okay, I wonder how expensive Monster is. Oof. So, interesting. So the multiples actually that Celsius is at now are the same basically as Monster. which I guess Monster would be their closest peer or rival, I guess. So that would be, I guess, like Coke and Pepsi trading at the same multiple. I guess it makes sense. Yeah. Or another way of saying it is Monster has a PE 30, but also has a wider moat potentially. Like who is the defender and who's the attacker, right? It's curious. To be honest, though, I'll just say it like this. I'm not interested in Monster or Celsius at these prices. Just to be 100% real. Just out of curiosity, I wonder how they do compared to like the legacy. Okay, it's pretty similar. And yeah, I'm not interested in Coca-Cola at this price either, by the way. And Pepsi. How are we doing, Pepsi? Pepsi's a little cheaper, actually. Funny enough. At least in terms of operating cash flow and PE. Free cash flow, not as good, but I'm sure there's probably some explanation for that. I would rate Pepsi as cheaper here. Yeah, but Pepsi has like almost no growth. Yeah, I'm not sitting here about to pay premium valuations for any of these beverage companies. Like a beverage company, even if it's like, okay, maybe if it's fast growing, you pay mid-20s, something like that. But for like 0.8% growth, 2% growth, whatever, paying like 30x, like what in the, like they need to take like a 50% haircut, to be honest with you. Like, it's just stupid. They're more like, these companies are literally, in terms of their operating cash flow, more expensive than Amazon and Google. Are we saying that a bunch of cola and energy drink companies have a better moat than Amazon and Google? It's like, it's borderline ridiculous. I think if there's a big market pullback, maybe some of these dinosaur companies that don't grow anymore but have ridiculously high multiples need to take a haircut too. Coca-Cola, McDonald's, Pepsi, Monster. Celsius maybe doesn't need to fall too much more if they keep growing at least reasonably well. Heck, Stabulo makes a good point. Coca-Cola is always a buy. I keep forgetting that's the number one rule of investing, is that Coca-Cola is always a buy. No matter the price. Apple too, right? Apple and Coca-Cola are always a buy because Berkshire Hathaway owns them. So, Cabo, I have actually mentioned that exact possibility on my Discord. Because, so my general understanding of the like Hedgeye / Viceroy short campaigns is that they are generally successful at dropping share price. At least temporarily. Which means, yes, riding it down with puts is an interesting idea. You ride it down until you make a reasonable profit, you take your gains, and then when it hits what looks like a bottom, sort of how, like, I don't know if it'll drop as drastically as MPW, by the way. But there's a good chance it will drop considerably if they persist with their short campaign. In which case, you take your gains at a certain point, and then when the timing is right, or when you suspect the timing is right, you flip some of those gains into a long position and ride it the other way when their story sort of starts to fall apart. Which I think we're at that stage now with MPW where their story has started to fall apart, which is why Hedgeye took them off the public list. They will never admit that it's because their story fell apart and that it was never actually a zero. They won't say that, but they will just, oh, okay, it's off the list now. Now we're focusing on ABR. We got our win on MPW. The price went down a lot. We were right about that. They'll paint it as a win. They'll gaslight people a little bit. They promised a zero, but it wasn't a zero. But they'll brush over that part and skip right to the part where, well, but it did go down like 70% after we started shorting it. Therefore, we were at least kind of right, sort of. We made money. We made you money if you got in when we did and got out when we quietly took it off the list. But yeah, Arbor, it's right. It's early days for Arbor. They've only really just kind of in the last few months really started to work in the negative posts here and there about Arbor. So I think Arbor has some potential to fall, and I don't think there's anything from what I've heard from people who have been following Arbor is that there's not really anything fundamentally wrong with the business, though it is a mortgage REIT, and like if there's a problem in the housing market in the near future, that would play in. Like there is some data that suggests there could be some trouble in the housing market in the near future. And you could see that hit Arbor's share price if they can work that into their short narrative. But all in all, Arbor actually, from what I can tell, seems like one of the better managed MREITs out there. Like, if you go back into the past, 10 years ago, their dividend was 12 cents, 12.81 cents per share, and it is steadily climbed. Now it's 43 cents a share. So, like, it looks like, their dividend, most MREITs that I've looked at in the past actually have their dividends shrink over time because they're just not managed very well. But yeah, Arbor appears to have grown shareholder value and dividend payouts over time. So, granted, I don't have the history for what was going on during the 2007, 2008, 2009 era, the Great Recession, the big real estate bubble. I don't know what happened to them then, but the last decade at least, their track record's been solid. So I wouldn't necessarily inverse Hedgeye because there could be periods of 2 years where you eat a bunch of pain while their short thing actually does hit share prices. Like I've been doing that in practice with MPW since it was $10 a share. And granted, I had enough resolve to increase my position at the lowest of lows to get my basis down. So now if MPW plays out even reasonably well, I'll still get a kind of attractive gain. But the smarter play would have been recognize that something is afoot that's going to drive share price down, ride the downtrend with a directional small bet in options like puts, and then flip it to a long when it's clearly the darkest period for the price. And I think when it was $3 a share, it was pretty obvious that negative sentiment was at its maximum, and even strong bulls were questioning their life choices at that point. I bought more shares, by the way, at that point, rather than selling. I was definitely feeling it, though. It was not psychologically an easy thing to do. But yes, 100% I'm strongly considering playing Arbor directionally. But I'm not much of a trader type person. I still like I'm a valuation person at heart. If I can spot what looks like undervaluation, I tend to gravitate towards that type of investing. It's like, oh, I'm buying something that's worth more for less. Like, that's easy. With the directional stuff, it's like, I'm kind of trying to time things, and my timing historically, it's very hit or miss, to be generous to myself. As Tabulo will point out, my timing is not generally impeccable. Like, if I suddenly become interested in a stock, people who are already in it, they think about getting out because it sort of becomes a catching a falling knife situation. Many stocks have been known to fall immediately after I get interested. Granted, some have gone the opposite way. Like, I did call close to the bottom on Palantir and Clove and made okay money on those. But it's just, I wouldn't put any stock in like my market timing or technical analysis, which I don't do any chart reading or anything like that. So, yeah. Yes, the frog emoji and the coffee emoji. Those are emojis. I'm not fluent in emoji, by the way. But yeah, that could be fun, playing Arbor. Now Tesla is one. Wow, 8% in one day. That's gotta hurt. Can you imagine? And here's the thing, it's still expensive. Okay. Several times more expensive than Google or Amazon for Tesla. And you might be saying to me, fiscal philosophy, you're not very smart at all. The growth is clearly much, much higher. Eesh. Not recently. Not recently. Yeah. That's rough. It seems as though the growth has come to a screeching halt the last few quarters for Tesla. But surely they're rapidly pulling the profitability levers. And nope. No, they're not doing that either. Not doing that either. Yeah, it's not good. Yeah. This is one where Tesla is almost more of a cult of personality around Elon Musk than it is an investment idea, in my view. Are they a business that can make money and stay around? Sure, but I don't think it's going to generate good returns at this level. Or if it does, it's going to just be sheer enthusiasm and not really based on anything that they generate cash flow wise. Car company parading as a tech company. Yeah. Yeah, definitely would not touch this at current levels. It needs to take a pretty substantial haircut to be like actually investable. Yeah. Yeah, Tesla has they've delivered a lot of interesting things. Like, I test drove a Model S in 2018. It was very fun. I used the autopilot feature and all that stuff. Like, I'm not knocking their products or anything like that, but they have a history of over-promising and under-delivering. Robo-taxis have been right around the corner for years. Full self-driving has been right around the corner for years. Roadsters and semis and yada yada. So, yeah, they're generally speaking a day late and a dollar short with a lot of the stuff they come out with, in spite of how cool it is. Like it's very cool. Their cars are very cool. I will not discount like how awesome their cars are, and the fact that they are the category leader in electric vehicles. That's not in dispute. But at the end of the day, people buying a car are buying a thing to transport them from one place to another, and the margins on that are only going to be so good. And at the end of the day, people have to decide, am I going to spend the money it takes to get a Tesla, or am I going to buy like a used Toyota Corolla? Right. Optimus Prime. Yeah, Disney's further with the animatronics. Yeah. True. But yeah, I think Tesla still's got a ways to go. So yeah, it'll be like Apple, possibly NVIDIA, Tesla. And you know, people might, I was actually thinking about this a little bit as well. And people might disagree with me on this. But I could actually see something like Visa, even if consumers are weak, credit card defaults are at a high. I could see something like Visa taking some hits too. I mean, they definitely trade at a premium, which is understandable for their moat, and they still have decent growth and stuff. But if there were some problems with the consumer and they can't spend as much, that means fewer transactions, which means fewer transaction fees. I could see Visa going through a bit of a correction in that instance. And there are some signs that, consumer debt, credit card debt is at a high. Defaults. There's some alarming numbers about how many accounts are 90 days or more late right now, credit card wise. So, yeah, I mean, it's a 500 billion market cap. So companies like this, and plus the Mag 7, the ones that are vulnerable there, yeah, it could get ugly. Like, you could see a pretty big overall market correction led by those companies. And it's just about what companies are actually good deals right now and would just be better deals in the event that they fall in sympathy. And yeah, I think if a correction brought Visa down, like any substantial amount, then that would be that would be an interesting pickup, right? And probably same story for MasterCard, I would think. Which looks like it's maybe a little bit more expensive than Visa. But I'm going to guess that the growth is probably higher. Yeah, so a little bit more expensive than Visa. But yeah, the growth is a little bit better. So yeah, I think a big pullback in the market where these companies are involved. Some of them may end up as good pickups. Some of them it may just be going from a bit inflated to appropriately valued. You wish you could buy SpaceX. Yeah, I mean, SpaceX is so much better than Boeing as far as what they're delivering for NASA. Boeing is just a shit show. An army of robot Mickey Mouses. Yeah, that could be cool. I'd be down for that. I'd be about that life. All right. Well, we're coming up on the hour and a half mark. I would just like to remind everybody that the Discord is linked in the description, and that is free. And there's no strings attached there. I'm not charging anybody to join the Discord. Never have, never will. There's, at the current moment, over 200 people in Discord. So definitely a lot of perspectives in there. There are some people in there that are more experienced, certainly have more money and more accumulated wisdom about the markets than what I have. They're always interesting to talk to. There are people that are maybe newer with less invested, but just starting their journey. Sometimes fresh eyes can also bring a new, fresh perspective. Hey, Discord, yeah, Discord's popping. Discord's popping. Listen to Cabo. Listen to Cabo. Also, if you're not already subscribed, I am trying to get to 3,000 subscribers. Something that I do that I've been mentioning a little bit more often lately is every time I hit 1,000 new subscribers on YouTube, I let you guys pick a $1,000 stock purchase that I have to do. I do all of this in a YouTube pie that I put together on M1 Finance. Stocks that you guys have had me buy before include stocks like Visa, which I was just talking about earlier, 3M, British American Tobacco, Nintendo, Realty Income, and Medical Properties Trust. So far, that YouTube portfolio is actually up substantially. You guys have a good track record of picking good stocks at good times for me to buy. So I appreciate that. Also, on Twitter, or the X platform, I will be doing a similar thing when I hit 500 followers there. I'm at 350 right now, at Mr. Macho Mog. I think the link is in the description. If you follow me on there also, the way to help that grow after you follow is to, of course, interact with the posts that I make and comments I write by liking and replying. That tells X that people are interested in what I'm saying, and we'll send it out to more people. Much like the YouTube algorithm does if you like and comment and chat. So I appreciate your help there. And we do have a partnership with Moomoo, which is a brokerage. They have 6.8% margin rates, which are cheaper margin rates for those of you who know how to use margin, wink, wink, than either Robinhood Gold, which is a paid service, or M1 Plus, which is a paid service. So cheaper margin rates, no cost associated. There's no membership fee or anything to join Moomoo. And if you sign up with my exclusive link, which is in the description below, you get 15 free stocks with a $1,000 deposit, and you can qualify for 8.1% bonus APR, APY, which is pretty generous, market beating for sure. And of course, it helps support the channel when you use my link. So anybody that's interested in that, I definitely recommend at least giving it a try. They have so many more trading indicators than I know what to do with. Perhaps some of you can go on there and tell me what some of those bars and graphs and charts and lines actually mean, and help me with my technical analysis. Also, every Saturday at 8 p.m. Eastern, I am on the Cashflow Kings Live YouTube channel, which we'll just say it's been growing lately, though the subscriber growth has stalled somewhat on there, though our channel memberships and such are taking off and our viewership is way up. We stream there both on YouTube and on the X platform. And on some occasions, we've managed to get combined live viewership in the 200s of people watching live. So that's pretty impressive. We have all kinds of financial influencer guests. People like, for example, The Coach, Capital Mindset, SCHD He's a guy on X there that talks about mostly SCHD because it's his big investment. Actually, I'll go on. I think SCHD Stan, but his real name's Craig. This guy's super awesome. Also, if you want to support my channel just directly, I have channel memberships as well. There is a members only post where you can recommend stocks for me to cover and make videos on. I'm typically pretty open to do that if it's a stock that I would at least consider at any point. So I definitely want to encourage you to go ahead and do that. Yeah, it was SCHD Stan, but his real name was Craig. I was having trouble summoning that. Yeah. So now that we've hit the hour and a half mark, I think I'm going to just pretty much call it a day. On streaming, I'll probably just do a regular video tomorrow. Don't know what stock yet. Feel free to recommend in the comments or in the chat. Hopefully, I'll see you there, and I'll see you on Discord. Have a wonderful rest of your Sunday. Enjoy September. Don't panic, sell, and be at paper hands. Take it easy, everyone.